This technical analysis video is going to focus on the types of market trends that we have. And basically the market can go in three directions. We're either going to go up, down, or sideways. For us, what's really important is how are we going to integrate our timing analysis into the technical analysis. In short, technical analysis doesn't work. It doesn't work all the time. It works sometimes. And this is why humanity has come up with a bunch of different ways to analyze the market, which is fine, not a problem. Because on the one hand, nothing works. On the other hand, everything works, but only sometimes it works. And if we don't really manage it with time, our trading success is not going to be very good. In fact, most of the techniques that you see on YouTube won't actually get you profitable over the long term. And if you do a back test and intensive evaluation of what they're teaching, you'll see that more often than not, they'll be causing losses. So what do we want to do? Well, we don't want to disregard technical analysis because it works sometimes. And we don't want to disregard other technical analysis methodologies and just stick to one, because some of them work sometimes and the other ones will work another time, and so on. So knowing a few different types of technical analysis is good for us. So if we were to start with the basics, we'd need to know the direction. The market can go sideways, up, or down. There is no other place it's going. If we take a look at the chart that's in front of me, this is euro dollar. If I tighten this up a little bit, this is the daily chart. Now on the daily chart, you can see the market is going sideways. It's just obvious for us. All right. See, the market is going sideways. Here we had a bit of a trend. Whoops, let's do this. Just bear with me. We had a bit of a trend here, as you can see. Let me get rid of that. Where the market was going sideways and then it broke out. Okay, which is fine. So the market's either going to go, like I said, up, down, or sideways. Let's find a downtrend as well. Here we have a downtrend. Okay, the market went down, steady. Then we did a bit of a sideways market, a bit of an accumulation, and then the market broke out and did an uptrend. Now we're going sideways. Now the market after this sideways move can go two ways. We're either going to break to the upside or going to break to the downside. There's no other way and other place it can go. So understanding that for a start is good, because if we know we're going sideways, we want to make sure we're trading the edges. What does that really mean? I want to buy the lows and sell the highs. And here you can see some lines which are basically just demand and supply lines, which means for me it's the same thing. I know there are a lot of terminologies out there, but for me everything consists of support and resistance. Whether you call it order blocks, demand and supply, I don't know, whatever you call it, it just doesn't matter. There is a price level where the market is bought heavy. There's a price level where the market is sold heavy. If you trade at those specific levels, you have a higher chance of succeeding. So here's the euro dollar. We're going sideways, and what we want to do basically is buy when the market is down, sell when the market is up. But I just did a video today with a case study, and it's in the archive, and it shows me that we can go long here, right? So isn't that a bit contradictory, you might say? Well, in the upcoming videos that I'm going to do in technical analysis, you'll see that we'll be able to enter markets if they break out like they've done here. All right. Why? Because that's a retracement which we can go into, and I'll also show in further videos how to go about trading them. So if I was to trade any market, let's take a look at, for example, NASDAQ. Whatever you're trading, it doesn't matter. Always look at these things. What direction is the market going to? If you open up your daily chart, you'll see it's obvious. We're going sideways. That's it. There's nothing to talk about here. In fact, this is a quite nice setup, as you can see on the daily. The market had a big fall with an ABC retracement, which we're going to talk about in later videos. Crashed again, closed under that closing price. Going up, now we're selling off. All right. So what we want to really do, whatever the market is doing, if it's going sideways at the moment, this is actually, it's got bearish tune to it, as you can see off the heavy selling, right? Heavy selling, raising its head up a little bit, and another heavy sell. And you can see the buyers aren't that strong here. Not a lot of enthusiastic buyers here on this daily chart. It's just, it's going up, but it's not very enthusiastic. It's not like a big impulse. It's not like a big impulse, okay? So it's a bit weak. By looking at the market's direction, whether I'm going up or, let's do it this way, for example, market's going sideways here. Let's make this a little bigger, okay? If I understand that the market is going sideways, I can then match the trading day, the vector day, and also now what I'm putting is the swing periods day or days. Then you have a much better chance of following that through. We're also going to look at some price formations later on. But the most important thing in this video is the minute I open up the chart, I want to see if we're going up, side, or down. That's all. All right. And if we take a look at anything, let's just look at gold as well. Because we're trading intraday or we're trading for a few days off the week, if we're going to follow doing like short-term swing trading within the week, what we want to look out for is seeing what the market is doing in the close past, close history of the market, like 2 weeks, maybe 3 weeks, so we can catch a price level and work with it. All right. And this is why trading days are important. So for example, this is the daily, right? And Monday I talked about the market being tricky, and this could go both ways. And today is Thursday, as you know, and it's a trade day today, so we can actually put an arrow into the trade day here. Why am I buying today if it's a trade day and we're like in the middle of nowhere, right? Because that's a low, that's a high, okay, and we're in the middle of nowhere. But if you look closer a little bit, you'll be able to see that over the past 10 days or 2-3 weeks, the market is really just going sideways, right? If I did that, all right. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So it's like 2.5 weeks, all right? Nearly 3 weeks happening there. So as you can see, the market is going sideways. So what I want to do is this, because we're, like I said, short-term swing or intraday trading. What I want to then do is obviously buy lows, all right, and sell highs because we are going sideways. So if I'm low on a trade day and I've understood that, I'm going sideways, I don't mind buying the lows here. Where can I get in? Where can I not get in? And just check it out here. Also, if you know the red candle rule, okay, which I'll talk about later, you can also, mark a red candle. But the important thing is you understand that within the time period you're looking at, like maybe 10 days or 20 days, your, direction is clear for you. The real motion here, as you can see on the impulse, is a big down, all right? But the market's filled in the gaps here. You see I've drawn those lines for us. The market has filled in the gap. It's nice and easy. And then going to the upside. So if you take a look at your archive, this is March. You might not see it because the new website only has the recent ones. But in the previous website, you can check the archive and you'll be able to see that there is obviously trading days. I think it was here and here or here, like pushing to the upside. So obviously buying the lows here to go up was the way to go. So here I'm just looking at an opportunity to keep pushing to the upside to close in those gaps here, as you can see, and find myself back up here, as this is a good 1, 2, 3, and I'm expecting a fourth move there. So after the hit, 1, 2, 3, going to the upside. This is why I'm gold. My bias is long. So on the trading days, if I am down, I want to be looking to go up at the right price and at the right intraday timing window opportunities, which is on the website. All right, so you look for the intraday timing, you look for the trading days, you can look at the vector days to see how the market is. You can also look at the swing trading periods to see how many days that move can go forward, and so on. So this is the 23rd, this is the 22nd, and this is the 21st, and that's the 20th. Now, in the members area as well, if you are quarterly or annual member, you'll see in the members area, there's a place called swing day periods. And on there, you'll see for this week, I had 20th of April on a start and on a peak day. And this is your 20th of April there. All right. It's in the middle of nowhere. So this is why I said this could go up or down. I'm not sure what to do with this. But if I was to have an up or down candle like this, a range, you see a range where the market is staying within the range, I can say, well, okay, fair enough, we're going sideways in this short-term period, so buying the lows at the right time is the way to go, and that's called support or resistance. And here we are at the trading hours going up into the targets. All right, so the important thing is, where did they buy heavy, where did they sell heavy? Trading the edges. If I am not in the edges, then I still look for a side up or down move within a range or within a limited time period. In this case, it's going sideways. Sideways trading is normally known as being dangerous. It's only dangerous if you don't know the trading day, the trading hours, and obviously the pricing. Okay, the pricing is not difficult to know. If you're going sideways, you want to buy the lows, sell the highs. There is an impulse to the upside, and if you take a look at the weekly chart on gold, we actually have an opportunity to go up or down. We don't know where the market is going. You can never, even with timing, you can never be 100% certain that the market's going to go up or down. But because you know the trading days, if we are down, you know we can reverse that out. And you know the intraday hours where you can do that at the right price if time, price, and if time and price match. So whatever we trade, let's take a look at even silver. Let's open up a daily. As you can see, this is silver on the daily. Whatever you're trading, you immediately know the zone that you want to buy. As you can see, look, this is also very weak. Not a lot of buyers, all right, in silver at the moment. You see how this shock sell-off came, and there's actually gaps to fill down here, all right, in this zone especially. So we might see silver coming down before going up again, and that would take us into 55, which is not a bad place to get back into the game. So if I can measure these price levels from before, if I can see where they bought heavy before, then I can certainly match the day if we get to a place where they bought heavy before. But if they bought somewhere heavy before, then you might say, well, why you need the timing? You can just say they bought heavy here, so let's just go heavy. Yes, you could do that, but wouldn't you like to have something that confirms that this is the day when that is highly likely to happen? And that's the whole beauty about it, that on this day we're looking for something powerful. On this day we're looking for a turnaround. On this day we could be looking for a breakout. And the beauty is, on the vector days, if you go to your weekly market timing and you come to the current week, you'll see here the vector days, right? So you'll know what days are highly likely strong or weak or draining and so on. So if you know them, or if it's a routine week, for example, we had for gold, it's a routine week, so we're just going to do regular technical analysis with timing. What does routine week mean? It means I'm not really expecting any dramatic up or down moves. This obviously doesn't mean I have to relax my money management, but it does mean that, I can expect the market maybe to go sideways. I'm not expecting a lot of volatility at the moment, so I can just make sure I'm trading at the right time and price on the edges if it's going sideways. And if there's a trend, I'll wait for a pullback in order to catch the next wave, and so on. So the important things to look out for is where they sold heavy. So how can you really know that? Well, there's a red candle and a blue candle rule. It could be a green candle as well, depending on what color your chart is. I like to look at places where the market sold and caused a break of a swing like it did here. You see how the market sold here and just caused a break. This is also a blue candle. Look, blue candle. The market had support here, right, on this level. It didn't break, but this blue candle here, let's make this a little bigger. This blue candle here, you see how now the red candles broke that swing level. So this is a place where the market sold heavy because it caused a swing level to break. And that's the best way to memorize it. Keep it nice and simple. So this is the bar. All right, I'm going to take the body here, the opening and the peak. But you'll notice there's a bar here as well, which closed the gap here. Let's put this up here. Right, you see there's a bit of a gap which the market pretty much closed. So what I want to do is I want to take the wick as well. All right, the wick, because it's higher than this bar. So this is going to be the zone where it's going to be a sell zone. Okay, so always look for the last up candle before a swing is broken, or the last red candle before a swing is broken, like it's broken here. So if I, for example, wanted to, I'd be saying to myself, well, this is a place where they bought heavy. I might want to buy here. And you can see there's just crashed down. So it doesn't work all the time, right? But that's technical analysis, which is what I said in the beginning. So what would you need to do if you wanted to get into a trade on that day? Right? You'd say, well, is it a trade day or not? So then we open up our technical analysis book with the dates on it. So that is, let's see, that is the 18th of March. So let me take a look at that period. So 18th of March is a Wednesday, and on that week, Monday was the 16th, right? So let me put something on the 16th. That is your Monday, all right? So gold on that week had Monday and Thursday, not Wednesday. So that's your Monday. So this is Monday. Let me get rid of that. Monday, as you can see, market bounces up from the low. Logical. Why? Because this is where they bought before. Okay. But the market also made a big impulse wave and selling off. Now look, Monday, after Monday, we've got Tuesday, Wednesday, Thursday. Thursday was a trade day as well. So market comes down, rushes down, as you can see. What's the decent level to buy? Well, you look at where they bought before. That is where they bought before. And look, this is the red candle causing a breakout here. So in essence, you could mark this bar here and just extend it there. All right. So if you're then looking for a Thursday, let's open this up. You'd say to yourself, in this candle, I'm looking to go up. And Thursday, sure enough, was, let's put an arrow there. Market goes to the upside. All right. Now, it's not a big move to the upside. As you can see, the market sold off again on Friday, which is fine, but it's enough to save your neck. Now, the important thing is, on this day, all right, on this Thursday here, which is the 19th of March, how was our timing? Well, let's take a look. on the 19th of March. Let me pull this back. So let's go all the way into the 19th of March. Here is the 19th of March. As you can see, market came there. What is that? Did we have an hour? Now that hour is 16. So it's 4 p.m. Did I have 4 p.m.? Well, let's check it out. Let's see. The 16th of March. If I go into the archives and let's take a look at March. 16th of March. And I will show that to you. All right, now 16th of March. I posted on the 24th of April. We're looking at Thursday, 16th, right? So Monday, okay. Thursday is going to be 19, right? And that is the 19th, okay? So we're going to look at Thursday trade hours. Here we are. Now, what do I have? I've got 2:35, 4:25, 9:45, 12:50, 2:45, 3:40, possible push into 7 o'clock and later to 10 o'clock. So I'm just going to put this on the side here. Okay. Now this is 4 o'clock. Let's make this a little bigger. And what did we have? We had 3:40, right? And this is your 3:45. Now let's take a look at this 3:40, 3:45 business. Remember, we want to be in this zone. So this is the price range. So from 64.50 all the way into 66.93 is a buy opportunity for me. Anything below 66.93. So 66.93. 66. 66. Let's just round it to 67, right? 66.93 and 64.50. Let's say round number 64.50. 64.50 is there. All right, and that's it. And you are pretty much here. If you buy here, you're going to put your stop loss under there, aren't you? So you're going to wait for the next bar, which is this bar. Okay, because 340 was there, right? By the time that finishes, you're here. You are in the game here. So you dipped in, you bought on this bar, stop loss under there, your market's moving to the upside. All right? That is enough to cover your trade and take profit. Despite the fact that the market is going down, you are pretty much covered. Why? Because you're at a place where they sold heavy. It was a red bar that caused a breakout. Also go over that demand and supply course I did, which also includes cause and consequence. You'll find that trading this way is really practical and really easy. And this is why timing is the best way to trade, because whenever you have a level, you just check, well, is that trade day today? Okay, great. So what are the price zones I'm looking at here? So are we there at a trade hour? And that's just how things are, which is exactly, look what's happening here. Today, this is silver, mind you, but we can use gold and silver because they pretty much move together. Let's take a look at gold and silver. So gold has a Thursday, right? And today is the Thursday, 23rd of April. So if I was to also say to myself, okay, you know what, let's take silver as well. We'll trade it just like with gold. They're precious metals. What do we want to do? Okay, this is the place, this is the wick where they sold heavy. Okay, not really clear. Okay, also if you're in doubt, stay out. But why can we take this bar? Because this bar caused a breakout of this zone. So you could do this. Cause and consequence. This is the zone that did it. It's the wick, right? So all of this zone is a place where they bought to break out. So then all you have to do, just like we did before, let's just measure the price there. This is 74.81. and the lower that is 72.62. So today's trade hours, let's take a look at today's trade hours. Today's Thursday the 23rd of April. All right, here we are. These are the trading hours we have. It's actually 6 p.m. my time at the moment, 5:59 p.m. So we've got 1 minute to 6 o'clock. So 5:35 to 6 o'clock, for example, it was a trade hour. And then 1:55 here, look, expect disruptive moves as we get to next hour, which is 5:35 to 6. And these are the other hours, 12 o'clock, 6:30 to 7 o'clock. So let's put these on the chart, on a 15-minute chart, and then see when we came into this zone, right? So let's put them in. Let's get rid of this and let's push us all the way into the current day. So here we are. So all of those trade hours, let's put them in. Thursday we're in. The platform is currently at the same hour as I am, which is good. Now look, we had 155, remember? This is 155 bar. The pricing was 74.80, 72.60. So 74.80, 74.80, 72.60, 72, is it 72.60? Let me just double check. Yep, 72.62. Right, so 72.60 is here. Right, so this is where the market is, and this is a trading hour. So the market dips in, it's a trading hour, we've got a blue bar, another blue bar, this is your entry. And look what's happening. Expect disruptive moves. Now, nobody's going to give you this kind of comment, all right? They're just not going to give you this kind of comment. So now we've got 5:35 to 6 o'clock. Well, let's take a look. This is 5:35 here. And this is going to be a 6 o'clock bar, all right? And we're expecting disruptive moves in the market. So as you can see, market went all the way up, pulled back, and there's a bit of a gap here, right? So if you went long here, yet you definitely want to be taking profit. Now look where the market sold off here. Look where the market took a break. See, this is the most recent swing. This is a 15-minute chart, but the mentality is the same. This is the recent swing where the market went up. Then we have a breakdown. Look at that. It's the last blue bar before this whole swing level is broken. So the market comes back up here. And this is the first resistance. And you can see the market is down from there. Now, if we had a trading hour here, and then we said to ourselves, well, wait a minute, I can sell silver because the trend is kind of like looking down. Okay, great. This at a trading hour, you can sell because price and time matched. So that's going to be a really tight, close stop loss, low risk trade. And that's how it is. So by drawing these levels, support resistance, basically, that, like I said, I don't care if they call it demand and supply, order blocks, whatever. Where did the market move? What price level did they push it at? Up or down? That is your zone, right? And once you have a zone, great. All you have to do, mark your price levels, wait for the trading hours, and then trade then. If you like, you might want to go back to, you might want to go down to a lower time frame, which is also fine, but I normally keep and stick to a 15-minute chart. And if I see the market is turning here, I don't have to put a stop loss all the way down there. I can just put the stop loss below that swing level there. Why? Because if my timing is correct, the market shouldn't go down. And especially if I've made a comment like expect volatility, all right? Expect volatility as we push to 6 o'clock. The last thing I want to be doing is taking extra risk. So actually knowing that some volatile shit might be hitting the fan is all good, because all I have to do is then keep the stop tight, because if I am wrong, I don't want to get smashed. So knowing the time, knowing the price, knowing it in advance is the best edge you will ever have. And all I've shown you here is just simple support and resistance. Match your support and resistance, match it to the trading day, get your trading hours in. If you're there, use proper money management with your stop losses. You can see it's just a tight stop loss. Then you got your intraday targeting, and that's it. And if you just know how to do that, you're all set with timing and price. Technical analysis is best if you keep it simple. The more complicated you do stuff, the more in trouble you're going to get, especially if you have timing. It just becomes much more simpler. You just have a day to trade on, and you've got hours within that day to trade on. I mean, how simple can that be? And if it's not a trade day, don't muck around. Go fishing, go shopping, go to a cafe and relax, go to the gym, do something else. Because the whole idea of a trading day, a vector day, the swing periods, the peak and the beginning and the ending, those are the days when I want to be looking at the market. I don't want to be stuck in front of a screen all day, every day. I want to be picky, and if it matches my technical analysis, you go in with money management. You only need 5 steps when you're trading with me. Check the news, which I actually don't do, but check the news. The second is your technical analysis, your timing analysis. You make a plan and you trade the plan. You manage the trade and you do a post-mortem, and that's it. There's nothing else to do. This is why timing is the best edge you can have, because you can relax and plan properly. You can plan for the day, days in advance. Okay, so this is how timing can help you out. I hope you find this useful. Have a good day. And if you have any dramas, queries, you can always go to the website. I've also done a 7-day trial access. If you want, you can get in for 7 days, see what I'm putting out there, and use it on whatever you're trading. I'm looking at only 5 assets, as you know: gold, euro, dollar, Bitcoin, and the 3 US major indices. But you can trade the hours on whatever asset you're trading. The important thing is, like I said, match the time to your price. Have a good day.